Hey everybody, Bob Vieira here, founder and owner of Universal Short Sales, fastest growing short sale processing company in the country. I'm here today with Tamara Jennings. Tamara and I met, I think it was 2 weeks ago now. I was speaking at the Brandon RIA and she was in the audience. We were talking after, and then we kept in touch after, and she has some really interesting insights on the industry. She has a lot of, what did you say, 18 years mortgage industry experience, right?
Yes.
Tamara knows a lot of shit about the mortgage industry and the real estate business, and specifically mortgage delinquency and what's happening there. So after we exchange a couple emails, I just thought she knows a ton of information. She's really brilliant in this space. So I figured we would have a conversation and let you guys listen in. So without further ado, I'll let you introduce yourself.
Hi, everyone. I'm Tamara Jennings. I am a licensed realtor. I'm a loan officer. I'm also an underwriter. And primarily, I've been underwriting for the last 18 years. And I do anything from front end to back end. So I don't want to complicate people yet what the back end is, but that's the secondary market. That's the securities. That's when anybody gets their mortgage and you get a little letter that says we sold it to someone, then that new investor is who I do for a back end. I would go through that loan and make sure everything is in that file that they say it is, and there's no misrepresentation and there's no fraud, and it meets all the guidelines for both investors. And this is actually probably more important than doing front end underwriting, which would be approving a person of their loan in the beginning, because in the back end is where the actual true note holders I'm working for. So you could pay your mortgage to Bank of America, you could pay it to Wells Fargo. Those are usually servicers. Those are not your true mortgage holders. It's very few people, I would probably say 5 to 6 or so big banks out there that really truly hold your notes. And some of those are like Bear Stearns or Deutsche or HSBC, those kind of banks. It's not going to be your everyday bank that you're going to use. And so those investors buy your note from each other. That's what a lot of people don't understand. It goes behind closed doors. And so it's become such a big business since right after 9/11, early 2000s, that they don't, I want to say they don't care about the assets anymore, but it's more important for them to sell the note to each other because they make their money and they get that note off of their hands. So basically, they made their money, they're out of it, they sell it to the next person, and then they make their money. And then that next person has to carry on that loan.
How long do they usually hold it for, Tamara? What's like the average? Is there? Yeah.
It's different for each lender. So it's really hard to say. It's like whatever little formula that they use, it depends on who created your note, if it's wholesale or if it's retail. Wholesale or independent brokers. Retail is going to be the ones that works for the lenders. It depends on how big that lender is. A lot of notes get sold to Fannie and Freddie. Usually they're counting on that to get to Fannie and Freddie so they can get their money back. But if there's a problem with that note, then they start to go to each other. And that's where it starts to get interesting, because when they sell it to each other, here's how I want to relate this to short sales real quick. When they sell it to each other, they sell it in the thousands, right? So let's just say you're going to buy 5,000 loans from me. If there is a few non-performing loans that they can't sell to Fannie and Freddie, they're going to sell it to that investor. So what a lot of people don't know is they'll say, hey, you buy these 5,000 loans and we'll put these 10 non-performing loans in there for free. And they'll bundle it up in there. And those properties are usually non-performing loans.
Wow. And guys, this is actually a really interesting topic. I didn't even know we were going to get into this, but it's very, very important that she brought this up, because I know doing short sales, a lot of people get confused. And Tamara, you probably see this too, with thinking that your mortgage servicer, almost every seller I deal with thinks their mortgage servicer owns their note. And what Tamara is explaining is that's not the case. So Wells Fargo, SPS, all these people, they're just loan servicers. They're essentially middlemen, right? Is that fair to say?
Exactly. That's
Okay.
exactly what they're middlemen. They're hired from the investors to service that loan. So literally what it is, they're just
Yep.
servicing it. They don't own it. I think that's where a lot of people don't understand.
Yeah.
Somebody else owns it
Yeah.
behind closed doors.
There's
And the only way you're going to know that is you got to go to MERS, MERS. And you can go in MERS and plug in your information as a homeowner, and you'll go in there and see who owns your actual note holder.
I did not know that, by the way. So I'm writing that down. That's another nugget. That's a nugget right off the bat she's giving us here. MERS.
Yeah.
You don't have to be the homeowner, Tamara, to get that. Like if I go in, I could literally just Google, or does the homeowner have to do it?
They usually want the homeowner of the person, but you should be able to just plug in the information if you have the information of the property in there.
Gotcha.
And do it.
Okay.
But just one little caveat to that, right? That I found out later on. MERS was created when they were selling it to each other. So MERS is supposed to keep in track of who your note was sold to. MERS was made up basically by the banks to avoid paying recording fees. And MERS can go and enter it into that system anytime they want. So you heard when the last short sale came, too many people were coming. One bank was coming after them, right? So they were like, oh, not one bank, two banks were coming after the same person. Did you hear about that in the last recession?
No.
Where they were getting foreclosed on by two different banks, and the homeowner only made the loan with the one bank? Okay. So that's what happened. The notes were getting sold. They weren't keeping track of it. And so they had it on both of their books. And the person who got caught in the middle of the homeowner, because they're getting foreclosure letters from both entities and only one of them owned it. So the point was to put them in MERS, but they never enforced them to put it at MERS when they change it. The bank has whenever they want to put it in.
Just so I'm understanding correctly. So then the entity who owned the note, the actual note holder and the servicer were both sending them a letter, correct?
Not the servicer. It's
No.
actually two people that think they own the note.
Oh, they think they own the note. Wow.
Right. So what happens is when remember I told you I go through the loans and two buyers are doing it, right? It's going from one investor to another investor. Well, those investors are supposed to register that note transfer in MERS and say, hey, I sold it from Bank of America to Wells Fargo.
Okay.
The caveat to that was MERS was made up by the banks, basically. And so they weren't doing it. And their rule and policy is they can put it in at any time. So they could have bought your house 5 years ago, and then all of a sudden they're like, oh, they're being delinquent. Let me go stick it in MERS. And they stick it in MERS. So it's not a real accountability of when that note actually transferred.
Wow. That's crazy. That's genuinely crazy.
It is crazy.
So let's switch gears into delinquencies. When you and I were talking, you sent me an email and it literally blew my friggin' mind.
Okay.
To us about, because I'm not going to speak too much. I'm going to let the audience figure it out, but talk to us about lending and how high the DTI is, because I did not know it was this bad. You were talking about FHA loans.
Right.
Yeah.
Okay.
Talk to us about
that.
So
here's my biggest thing. I keep telling people that we are going to be heading into a big recession. There's just no way around it. The number one that I saw and did, I actually approved these loans, or FHAs, and we used the 57% DTI of gross income. Gross. You still got 30% in taxes. If you had a 401k, you did the max 6%, then you're at like what, 92, 93%. And then if you had high health insurance, you're at a bust. So it's not rocket science to know you're not going to be able to pay this mortgage. It's really common sense at this point. It used to be, just to give an idea, it used to really be at like 36 DTI of gross income. Then it went to 38. Then it went
really quick, explain what DTI is in case anyone listens to this and they don't know.
Okay, you're right. Debt to income. So it's like your mortgage, your car payment, your credit card, anything on your credit report is all going to be all your debt. And then we're going to divide it by your income, your gross income. So that means before taxes. And then whatever that number is at 57%, that is the max of what all your debt can be, meaning your mortgage, your credit cards, anything on your credit report, divorce, alimony, and child support. But we don't consider daycare. And that's something people really got to be realistic by. If you're paying daycare, guys, like the lender isn't going to use it against you, but you're paying it. And that's a big cost against you. But we're only going to take for all your credit report, anything that we can see. We add it all up, divided by your gross income, and that's the maximum amount of what your mortgage and payments can all total to.
Got it.
Okay. So we used to be at 36%, then they went to like 42%, then they went to 45%, then they went to 50%. Right now for conventional, the maximum is 50%. But then FHA decided to go to 57%, which is crazy because let me give everybody an idea. My average conventional borrower would make an average about $25,000 to $30,000 a month. That's an average borrower for me. FHA is going to be your normal people, your wife making $18 an hour, husband might be making $20 an hour. It's actually usually a little bit lower than that. And so just imagine when using 57% of that income to qualify them and get them into a house.
I have a question.
Failure.
I have a question. This sounds a lot like subprime lending. Would you say this is a form of subprime lending in your opinion?
Absolutely.
Wow.
Yep.
Wow.
So all they did from the difference between subprime last time, right? Last time they gave us adjustable rate mortgages and they had higher interest rates, like 7-8% was average and great back then. And then they had semi lower house prices. So now all they did was give you lower interest rates, higher house prices. And yeah, they did fixed income, which is good. But right now we're getting tested with higher taxes and higher homeowners insurance. So your mortgage is still going to fluctuate and go up no matter what. And then let me just say, for the last recession, hands down, adjustable rate mortgages is literally what caused us to go under. Like everybody wants to say it's the no doc loans. And he wants to, yes, I do believe that contribute. But adjustable rate mortgages, let me just give you an idea of how this works. If I qualified you at a 50% DTI, I already know you're struggling. Okay, I know that that's going to be kind of hard for you to make all your bills and pay your mortgage. There's no way any bank thought in 2 years or 5 years or 7 years when your mortgage adjusted that you're going to be able to pay this extra $300 or $400. I mean, nobody was getting a raise back then. You got like what, 10 cents, and like don't spend it all in one place. That would have been what, like 500 over the whole year. So they knew you were going to be able to pay your mortgage in 2 years if it exploded to $300 or $400 extra. No, it's not rocket science. If you could barely afford then, why would I think you're going to afford it in 2 years? And not that kind of increase. We're not talking $50 or $25. That's a different, you might be able to do that. But a whole $200, $300, $400, or $500, they knew what they were doing.
Why did they do it?
Because they really are in the business of taking back your home. Like a lot of people are like, oh, the banks don't want to own your home. Yes, they do. Think about it's like buying a car and selling it for a new price over and over, right? We bought it at the highest amount of money. And then all the investors came and bought it half the price. And I mean half the price. When I did BPOs, I'm going to give you an example of a friend of mine's. I sold her house for $257. In less than 3 years, she was foreclosed and they sold her house for $135. It was a 4.2 brand new built. Like nothing was wrong with it. Just to give you an idea of how much money they were taking off here in Florida. There was houses I did BPOs, I took hundreds of thousands of dollars and he bought it 6 months ago. So it just really depends on where in the recession you end up in, on what your value is going to be valued at. So they had all their little friends, I call investors, these type of investors, that's all cash buyers. They're AKA the bank's friends. They call them up and they say, hey, come buy all of our properties back at half the price. And then what did they do? They turned around and rented back to us at an astronomical price. So now everybody's paying higher rent, right? Because they bought apartment buildings up in that recession. They bought houses and they inflated the rent price. And so now look where we're at. High rent, high houses. And people are thinking that, well, I'm paying this amount in rent. Why can't I buy a house and pay the same amount? But the reality is when you get a house, you still have, bills to pay. You still have your taxes goes up, your insurance goes up. New homeowners don't take that into consideration. The new homeowners, they have no idea that their mortgage fluctuates every year.
What are you seeing right now as far as mortgage delinquency, Tamara? Are you seeing it tick up?
Yes. So I already did a project for, I'm not going to say the name of the bank, but it's a large bank. And they had me do all the delinquencies of the first of this year, which is kind of unusual. For mortgage underwriters, when we start to get laid off, it's usually like a year or so before you start seeing foreclosures start going crazy, right? And just a little insight, mortgage underwriters, when we get laid off, we are the first to go and we see it first. Because guess what? The lenders have a bad forecast coming. And so they're going to let us go. They're not going to pay us all these good salaries to sit around and do nothing when they know the market is going to go to crap. Now, if they had a great forecast, we'll also have jobs here. And I wouldn't be having this conversation with you because it'll be a while before it comes down. So when we get laid off, I typically go into the foreclosure sector because that's what's happening next. So a large bank had hired me to go through all the loans and make sure that they followed all the guidelines because these are non-performing loans. When I went through the loans, the guidelines are we gave them 18 months, no mortgage after COVID, an additional 12 months extended after COVID. So that's what, a little over 3 years they gave them of not paying a mortgage. So you don't hear the news talking about this, but there's plenty of people who has not caught up since COVID. It's been 3 years and they're behind.
Oh yeah, I
Right?
preach about this too. Yep.
And nobody's talking about it on the news. They're acting like the economy is great. No, it's not, guys. Like, listen, there's no way that in the beginning of this year, we already did those loans. And we're talking thousands. And I'm not talking about one lender that I did, let alone how many other lenders is out there that's beginning to start. Here's a good indicator. Go online and start doing foreclosure reviews. And you'll start seeing these banks start hiring us. And then you'll know that they're hiring us to do the foreclosures and get them ready. But my job for this particular project was to make sure that we gave them the full 12 plus 18 months and determine if people were behind, which most was. We did modify their mortgages. Here's the thing about that and this time around. Last time around, the lowest interest rate you could have got was 2% from Obama. That's the Obama program. 2% is the lowest, and then the lender has their own programs, which usually never favors you. So if you can not get that one, don't do that one. These lenders are now, they'll modify your mortgage easier than the last time. But the problem is there's nowhere for you to really go, right? If 2% is the lowest and you bought at 3%, I take 1% off your mortgage, you're going nowhere. Like, it's not going to lower your mortgage at all. It's really, really a small margin. So there's no room to help you this time around because you already bought at the lowest interest rate. And a lot of people bought $300,000 homes. So like your taxes is based off of your sales price. That's another big thing that I don't like about with these lenders. They gave loans and they estimated your taxes really low to get you in that house. And then the following year, your taxes are going to explode. And you're going to have about an extra $300 or $400 on your payment. You'll have an escrow shortage, and you'll have to have the time frame of what you paid too low for. And guess what? From that point on, it only goes up and never goes back down. So now your payment has fluctuated $200 or $300, just like an adjustable rate mortgage. That's how they get you.
From that project with the large bank, do you remember any numbers? Could you give us like an insight of at least like a ballpark of like how many mortgage delinquencies, percentages, anything like that?
I don't know because they don't actually give it to us like this, but I could tell you this. It was 65 people hired for this particular project over 4 months. So you imagine if we all do 2 to 3 loans a day at 65 people for one lender, for people who was all delinquent. And these are only the ones that they felt like they might need to prove themselves and whether they gave them all. This isn't saying this is all of them. These are like the ones that they thought might have a problem. And if they want to fight it in court, they already had us go through it to say, hey, we're good to go. We already know we gave them everything we're supposed to give them.
Got it. Okay. So then these are, would you say those were like seriously delinquent people, like 90 days plus. It's not people who were like 30 days.
Well, no, these are people who are 3 years behind because they never caught up.
Oh, God. Okay. Only caught up since COVID. Got it. Only not caught up since
Right.
COVID. Got it. Oh,
Well, they didn't get caught up. Their loans got sent to us. We modified them for them, right? But then they went back into default.
got it. Okay.
Yeah. You know why? Because the
This is
interest rates didn't do anything.
wow. This is crazy, guys. So then 65 people hired for a 4-month project, doing around 2 to 3 loans per day. And that's not even people right now that are just becoming delinquent. She's saying
Right.
that's people that have been delinquent for 3 years. So that's not even counting the people that are just becoming delinquent now. That is
Right.
crazy.
Right. And that wasn't FHA either.
So that didn't even count government-backed loans, Tamara.
Not FHA.
Oh my God. And so many loans are FHA that are delinquent too. Holy shit.
Right. And so many loans will be delinquent with FHA
Yeah.
because right now I'm not sure globally how everybody's insurance is going, but I could tell you from mine and everybody that I know, our homeowners insurance has literally skyrocketed. It had literally quadrupled. So everybody's mortgage is going up. If you were qualified at a 57% DTI, you already can't afford your house. And if your payment goes up an extra $200 for your homeowners insurance, now you're really not going to afford your house.
This is incredible information, by the way. And I have another question now, staying on the FHA, Tamara.
Okay.
Why is it, do you think, that the underwriters had to increase it to 57%? Is there a reason? Like, are people like, could they just not qualify at the lower DTIs? Like, why is it 57?
So first thing first, underwriters, we don't make the debt to income ratio. That comes from Fannie and Freddie directly.
Got you.
Yeah.
Okay. Okay.
So they make all the guidelines. We just go by them. And personally, I always tell people if I made the guidelines, a lot of people wouldn't get approved. And I'm not trying to be mean. It's just that like I don't want to set you up for failure. And that's what they're doing because everybody wants that house, that white picket fence house, and your life is going to be perfect. But when they come back for that house, your life is not going to be perfect. It's going to be anything but that. And I don't want to be on the receiving end of hearing the phone calls because in the last recession, I did modifications and short sales and foreclosures, and I helped try to keep people's house. But a lot of times I had to deliver bad news and tell them that, listen, get your affairs in order. I can't help you. There's just no way to go. Every bank isn't going to play ball with you. Every lender has their own guidelines that they go by. Like you were saying something in the meeting, there's a formula that they're going to go by your property value, what they think it's worth, how much you paid on it, how much money they think they can get for it.
Formula for what? When they're seeing if they're going to give you a mod, you're saying, right? A modification.
Mod, short sale, foreclosure, any of it. There's a formula that they go to find out how much money they're either going to lose or make off the deal.
Okay.
So it's not across the board. If anybody says, hey, I can guarantee I'm going to get your mortgage like modified or whatever, don't ever believe them because it's just different investors, period. And they have different rules for everyone, who they want, what they don't want.
Yeah. Tamara, getting back to like the DTI, why is it, do you think, Fannie and Freddie for that FHA, though, why is it at 57%? Why is it so high? Do you think?
Basically, I hate to say it, but to set you up for failure, to make you buy a house you can't afford. I mean, this time around, listen, you got to put a down payment and they get to keep that down payment when you leave. And then when they take the house and they buy it back and they resell it, they can resell it for close to whatever value that they bought it for. I mean, they're not really losing anything at the end of the day, the way people think that they're losing. And if they're not, they just sell it to their investor friends, right? And they get the money on the back end. So they really don't care about the home buyers anymore. It's not about you. It's a game. And it's a game of, we're going to give you a house. We're going to take your down payment. We're going to move you in and then we're going to take it back and we're going to rent it back to you for more than the price.
So then you don't think it has anything to do with them looking at borrowers and saying, wow, American homeowners are getting into way too much debt. We have to raise the DTI so that we even have enough people to lend to. You don't think it's that as well?
Oh, no, it's definitely that as well. But it's still going to equate to the same thing. They're still setting you up for failure, right? The game is still the same. They're pushing us to buy houses we can't afford. I mean, I'm listening to people like, oh my God, I got approved at 300,000. but I need 350 to qualify for a house. Well, just because they approve you don't mean you can afford it. So everybody's going out and buying it, but they use rent as their rationale. I have this conversation over and over and over with everyone. Oh, but I'm renting and I'm paying 2,200, so I might as well own a house. Yes, logically speaking, that sounds great, right? And it sounds like what you should do. But logically speaking, when the hole comes in your roof and something happens, do you have the money to fix it? When your AC goes and you need 10 grand, do you have the money to fix it? So it's like, it's a no-win situation for them at this point. Either you're going to rent for 2,200 or you're going to try to buy a house for 2,200. And then you're going to find out next year, oh, my taxes were shortage. Now it's going to go up. Or, oh, I moved in and my electric bill is $500 because the windows aren't installated properly and I have a car payment. They don't account for that. So I definitely think that they hired it up to make more people be able to buy because they need that money, the upfront money. And they call them stimulating the economy, but look what they're doing right now. Now they want to do the total reverse in such a hard way. We went from 3% interest rate to 7%. And everybody's wondering, like, why we're going in a downspill. Don't wonder why the feds didn't have to raise the interest rates up. They want to raise the interest rate up. To slow down
I give you a
inflation.
lot of credit. Tamara, I give you a lot of credit because you're one of the only real estate agents that I know that will actually be honest and say that. Well, I shouldn't say one of the only that I know. I know a lot of really good agents that are real, like you're being real. But what I should say is there's a lot of agents out there that know what you're saying is true, but they won't say it because they want to go chase a commission check. The fact
that's true too.
Buying a house isn't always worth it, isn't always the right thing, is 100% accurate.
Right. But here's the thing. And I always tell people, I don't talk to people as a real estate agent. I always talk to people as an underwriter. And I always talk to people as an underwriter who's done foreclosure reviews. Because if you're sitting down and I'm watching thousands of people lose their homes, there is nothing that feels good about that. And I wear their problems on my shoulders every night. I'm reading, I'm losing my house because of this. They have to write a hardship letter of why they're losing their house. And I can tell you all kinds of stories of why people lose it. And it's not because of their fault all the time. I hate when people put blame onto them. It's health issues is the number one reason why people actually file bankruptcy, first of all. Second of all is divorce. Okay. And then third is overextending yourself. So I rather not see people put themselves in a position where just as happy as you are going in the house is just as sad as you're going to be when they take it back.
Yeah.
And a lot of people do not account for the stuff that we don't take into account, your daycare cost, right? So if you went in, you had no kid, and all of a sudden you have a kid next year because you're feeling great, you got your big house, and now you have the extra room, you want to go get the kid, and now daycare costs you $800. Where are you getting that $800 extra to pay for daycare? You know, so it sets people up for failure. I feel bad because I got friends who calls me all the time and they're like, it's a time to buy a house. And I'm like, no, just wait for the market to come down a little bit more and then buy the house. And it's a catch-22 because now it's like, it's coming down, it's slow, but now interest rates are back high.
Yeah. Speaking of this, I want to it's a perfect transition. Where's the market going? The $1 million question. What do you see?
I see a lot of foreclosures coming up because they already been in foreclosure. That's the reality of it. From COVID, everybody did not get caught up. Most people didn't get caught up. That's inevitable. The DTIs that I approved at 57% for FHA, those are going to be like the first people to go. And then with the increase of food and taxes and homeowners insurance, I just don't see how people are going to pay it. Anybody has some great ideas of how people are going to come up with this extra money, let me know. But as far as I know, I don't see anyone pulling out this kind of extra money. I mean, we're talking food is inflated, gas is inflated, your homeowners insurance, your taxes, stuff we can't control. It's out of our control. So we'll see what happens, but the future does not look bright for homeowners.
Wow.
At all.
We're going to end on that. I'm sorry.
Okay.
It's such a great interview. And then we had to end on a dark note. I'm only kidding. But where do people find it? That was amazing information, by the way. People are going to get awesome value out of this. That was amazing. Thank you very much. Where do people find you?
Where do people find me?
Social media, email. Where do you want people to find you? If they want to reach out for information or to use your realtor services.
Yeah. I'm gonna have to send you like my email. You could do realtor.tamara@gmail.com, and that's REALTOR dot Tamara, TAMARA@gmail.com. You get my phone number. I would send that to you, and they can also call me if they need to, and I'll put something on your Facebook.
Cool. Yeah, yeah, and I'll make sure when I send this out too, they have all your contact info. So thanks again for coming. That was some crazy information. Some of it was, I feel like, informational. Some of it's a little scary when you digest it. It's crazy to see what's coming, but we have to be prepared.
Yeah. I would want to add one thing that no
Yeah.
one seems to be taking into consideration that I think just amplifies this. A lot of people are going to lose their jobs to AI. Okay. I've been having this conversation left and right. I don't think people understand how much AI is going to come out. So, with everything we do, do not underestimate who would lose their job in the process for this, because AI is across the board. This isn't just going to be the lower end people. It's not just going to be the higher end people. It's going to be across the board. And if everybody starts losing their job, who's paying rent? That's all I want to know. So it's scary, and I agree, it's very scary. And I keep telling people, and everybody is like saying, "Oh, AI has been around. AI has been around for a very long time." I agree, but it has evolved in the last couple of years. Trillions of dollars has been poured in. So just keep in mind that we might lose a lot of people who doesn't have jobs, and I'm not sure how anyone's paying rent.
Hmm. Maybe we'll have you on again to elaborate on that. The AI stuff,
Yeah.
I feel like we could do a whole nother one just on that.
I sure can. AI, I think, is probably going to be our biggest pressing issue before anything else. Like I will give you statistics. I'm on LinkedIn, actually, if anybody wants to look me up on LinkedIn. And I made it a habit to put everything on their AI coming out. And even I'm pretty shocked of some of the new things I'm finding out. I'm like, oh my God, I can't. They have one for underwriting guys and processing and realtors. Yeah.
Realtors too.
Realtors. Yes, they have where you can go to the house, plug in your code. It has a camera on you, and you can walk in the house, and they can look at you in there, and they're like, "Just divorce your realtors and go in and use this code. You don't need a realtor anymore." And while people, home buyers, would think that's great because they don't have to pay the commission, or they think they're not going to have to pay that commission, but it's not great because you don't actually have a person telling you what's good and bad about that house, but they don't know. Yep.
Wow.
Even underwriting, processing, they all have AIs. And we already have an AI, but now it's an AI that actually underwrites the whole file.
Hmm. I think there's a lot of good arguments, to defend realtors here. I think
Uh-huh.
there's a lot of good arguments against AI and for real estate agents. I mean, looking out for your best interests, negotiating, great realtors have great customer service. So
Right.
I don't think you can get that with AI. That would be me, defending realtors against AI.
Definitely. You won't get that with an AI. But the
No.
problem is that first time home buyers are not going to know that. They're going to go with, oh, we'll give you 3% less on buying this house. And now they see it's money at the end of the day, 3% less they're going to have to pay. So if you do that, they're not going to have someone telling, hey, listen, this house has CDD fees or HOA fees, or, just know that the mortgage might go up or whatever that you need to know about that house. They're not going to have that education. But too many people feel like realtors aren't worth anything. Like all we do is show you a house. They don't understand we actually are going to tell you what's good and bad about the house. They don't value that. It's much like home discovery for any of my real estate agents that was out there that used to hate home discovery. They'll say, drop your realtor and we'll give you 3% off of the sales price.
Wow.
That's what they did.
Well, listen, Tamara, I can have you going here for a whole nother hour just on AI. We should come back on and do a separate one. That'd be a pretty cool discussion. I think people would be interested in that too.
Definitely.
Awesome. Thank you so much for coming. I'm going to put all your contact info whenever I cut this up and post it. So thank you.
Okay.
Really appreciate it. Awesome information.
Sounds great. Have a good one.
You too.
Thanks for having me. All
Yep.
right. Bye.